Something just broke. And I'm not talking about a minor dip, a temporary correction, or some analyst's opinion on a slow news day. I'm talking about a structural fracture in the silver market that happened within the last hour, and most people won't find out until it's already too late. I'm OG Jhone AG, and what I'm about to show you is the kind of data that mainstream financial media won't touch until the damage is already done. So stay with me, because the next few minutes could completely change how you understand what's happening in this market right now. Let me hit you with a number first. Silver hit $121 per ounce just weeks ago. 1 year ago, it was $32. This morning, it's sitting at $77. And before you write this off as just another buy silver video, it's not. I'm not here to tell you what to do with your money. I'm here to show you what's actually happening so you can decide for yourself. Now here's the number that completely reframes this entire story. Even after suffering the single most violent one-day crash in silver's recorded history, a 37% wipeout on January 30th that sent silver from its all-time high of $121 all the way down to the mid-70s, silver is still up 140% from 1 year ago. Read that again, 140% year over year. So when people say silver is crashing, I want them to understand the scale of what we're actually talking about. A commodity that gained 277% in 12 months just had the biggest single-day crash in its history and is still up 140%. That is not a crashing market. That is a market in the middle of something much, much larger. And this morning's price action, silver hitting fresh February 2026 lows, dropping to around $77 to $78 globally, around 74,900 rupees per kilogram in India, is not happening in a vacuum. It is happening with three specific forces, all converging at exactly the same moment. And that combination is what has every serious trader I know double-checking their positions right now. Let me walk you through each one. The first force is what I call the Chinese liquidity black hole. Today marks the start of Chinese New Year. Chinese markets just closed and won't reopen until February 24th. That is 8 full trading days with the world's largest silver consumer, the world's largest silver producer, and the world's most active speculative market for industrial metals completely offline. Here's what most people miss about this. When Chinese buyers are active, they absorb selling pressure, deep pockets, massive volume. They provide a cushion that keeps violent price swings in check. When China goes quiet, order books thin out, liquidity evaporates, and any selling pressure that would normally get absorbed instead moves price fast and hard. We saw this exact setup in the days before the January 30th crash. I'm not saying history repeats. I'm saying we are currently inside the same window. Thin liquidity, maximum volatility, maximum uncertainty. That is not an environment to be sleepwalking through. The second force is the COMEX inventory crisis that nobody is doing the actual math on. COMEX, the main futures exchange where silver is traded in the West, is required to hold physical silver that can be delivered against futures contracts. This is called registered inventory. As of February 13th, registered COMEX silver inventory sits at below 98 million ounces. Now let me put that in context. In 2021, registered silver on COMEX peaked at 152 million ounces. We are down over 80% from that peak. But here's where the math gets genuinely alarming. March delivery contracts, which begin on February 27th, just 11 days from now, represent potential claims on over 400 million ounces of silver. COMEX has 98 million ounces available for delivery. The math does not work. There is not enough registered silver to satisfy even 25% of March delivery claims. And if that wasn't alarming enough, just last week in a single day, 3.25 to 5 million ounces were withdrawn from registered stocks in one session. The drain is accelerating directly toward the most critical delivery date of the year. I'll come back to February 27th, because that date is going to matter enormously. The third force is the Shanghai Premium, a $10 price gap that simply should not exist. Right now, while Western futures markets are pricing silver at $77 to $78, physical silver in Shanghai is trading at a $1.10 plus premium over Western spot. That's $87 to $88 for the exact same metal. In an efficient market, that gap shouldn't survive a single day. If you can buy silver in New York for $77 and sell it in Shanghai for $88, someone does that trade until the gap closes. The fact that this premium persists tells you one of two things. Either Western paper markets are severely underpricing real physical metal, or Eastern buyers are aggressively accumulating ahead of a supply constraint they can already see coming. Given that COMEX inventories are draining at record pace, given that Chinese markets just closed for 8 days, given that March delivery is 11 days away, I know which explanation I lean toward. Paper markets are mispricing physical reality. And when paper price catches up to physical price, it doesn't happen gradually. It happens violently. Now let me tell you specifically what shifted in the last 60 minutes that made me hit record right now. At approximately 6 a.m. India Standard Time this morning, Sunday night in the US, Asian markets resumed trading after the weekend. Silver opened with immediate selling pressure. Not gradual. Not slow. Immediate. The support level that had held for weeks broke clean. No bounce, no defense, just straight through. The $78 psychological level in Western markets, which had been defended multiple times over the past week, was tested and broke during Asian trading hours. Volume spiked in the first 30 minutes. And this is the part I want you to really hear. This was not retail volume. These were large, coordinated, institutional orders hitting the market simultaneously. This is positioning, not panic selling. But here's the critical detail that changes everything. The physical market hasn't followed. Dealers in India report that buying interest has completely evaporated, but so has selling. The retail market is frozen. Nobody is buying at these prices, but nobody is panic selling either. What does that tell you? It tells you this entire move is happening in the futures market, the paper market, the market where leverage lives. Futures markets can be moved with leverage. Physical markets cannot. When those two realities eventually collide, one of them has to give. And based on everything I'm seeing, it won't be the physical market that blinks. If you're finding this valuable, hit that subscribe button right now, because as February 27th gets closer, I'll be dropping real-time updates that you simply won't find anywhere else. Now let me walk you through the 3 scenarios for where silver goes between now and February 27th, with my exact probability on each one. Scenario 1 is a capitulation sell-off. I give this a 30% probability. In this scenario, shorts use the thin Chinese New Year liquidity to press their advantage hard. They drive silver down to $70 to $72, triggering stop losses and margin calls on over-leveraged longs. Panic selling accelerates the move. The key level to watch is $76. If that breaks with volume, we're heading to $72. If $72 breaks, we test $70, which was the exact low hit during the January 30th crash. Why do I give this the lowest probability? Because COMEX inventories are too low and industrial demand hasn't weakened. You can push paper price down, you cannot conjure physical silver out of thin air. Scenario 2 is consolidation in the 70s. This is my base case at 45% probability. Silver trades sideways between $74 and $82 through Chinese New Year. The market holds its breath, waiting for China to reopen on February 24th. Volume stays thin, volatility stays high, but no directional breakout. Then, as February 27th approaches and the delivery clock ticks louder, we get clarity on direction. This is the everyone waits and watches scenario. Scenario 3 is the one that has serious traders quietly pricing in risk through their options positioning. A March delivery squeeze. I put this at 25% probability. Here's the setup. As first notice day on February 27th approaches, holders of March futures contracts have to make a decision: roll forward, cash settle, or stand for physical delivery. If even 25% of March contracts stand for delivery, that's 100 million ounces being demanded. COMEX has 98 million ounces of registered silver. If that math plays out the way I'm reading it, COMEX either has to force shorts to go buy physical metal in the open market to deliver it, or they change the rules. And if they change the rules, watch what happens to the Shanghai premium. Watch what happens to global confidence in Western paper markets. Watch what happens to the price of physical silver when buyers worldwide realize that paper promises are not the same as real metal. This is the 25% scenario, with a 100% chance of being historic if it actually happens. I want to spend a moment on February 27th, specifically because I don't think enough people understand why this date matters. First notice day is when holders of March silver futures contracts can officially demand physical delivery of silver from COMEX. In normal markets, 90 to 95% of contracts never result in delivery. People settle in cash, roll forward, close positions, but these are not normal markets. And here's what makes this moment different from any prior delivery threat. After the January 30th crash, where U.S. Treasury Secretary Scott Bessent publicly blamed Chinese speculators for the volatility, global confidence in Western paper markets is already shaken. If COMEX changes the rules in March to protect the short side, it won't just be a market event. It will be a credibility event. It will confirm what Eastern buyers already suspect, that Western paper markets are not backed by real metal. And when that confirmation lands, the Shanghai premium won't be $10 over spot. It could be $50. It could be $100. However much it takes to find physical silver that actually exists. 2 markets. One for real metal, one for paper promises. That is the world this could be heading toward. Now let me give you the exact watch list for the next 72 hours. These are the 4 signals that will tell us which scenario is actually unfolding. Signal 1, volume and momentum in Asian trading tonight. Watch the first 4 hours of Asian trading Monday night into Tuesday morning U.S. time. Sustained buying pressure with price stabilizing above $78 tells you physical buyers are stepping in despite thin liquidity. That's a bullish signal. Continued selling with increasing volume tells you shorts are pressing while China is offline. That's a bearish signal. This is the clearest directional read we'll get all week. Signal 2, the Shanghai premium on Tuesday. Shanghai is closed Monday, but Hong Kong stays partially open. If the Hong Kong physical premium widens from $10 over spot to $12, then $15, then $20, That is your early warning that Eastern physical demand is outstripping Western paper supply. A widening premium during thin liquidity is the classic precursor to a squeeze. Signal 3, the COMEX Daily Inventory Report. COMEX publishes inventory data every single day. If we see another large withdrawal from registered stocks, anything over 2 million ounces, that confirms the drain is accelerating into March delivery. If registered stocks drop below 95 million ounces this week, March delivery becomes a genuine crisis, not a theoretical one. Signal 4, options positioning at the $80 and $85 strikes. There is massive call open interest at those strikes, expiring this month. As silver approaches $80, market makers who sold those calls have to hedge by buying futures. That creates mechanical buying pressure, what traders call a gamma squeeze. Watch how price behaves as it approaches $80. If it accelerates through rather than stalling, the squeeze is engaging. Now let me zoom out for a second, because the silver story isn't really about silver. It's about the monetary system we've all been living inside, and the cracks that are starting to show. In 1971, President Nixon closed the gold window. The US dollar was no longer backed by physical gold, it was backed by trust. For 50 years, that trust held. But look at what's happening right now, all at once. Central banks are buying gold at a record pace, over 1,000 tons annually. BRICS nations are actively building alternative trade settlement systems, specifically designed to reduce dollar dependence. Countries like Poland are publicly citing national security as the reason they need to hold physical gold. And in Shanghai right now, physical silver is trading at a 13% premium over Western paper markets. These are not random events. They are symptoms of a system that is slowly, quietly losing credibility. Silver and gold are the thermometers measuring that loss of trust. When the temperature spiked in January, when silver hit $121, that was the market screaming that something was broken. When it crashed 37% in a single day on January 30th, that was the system pushing back, trying to restore the illusion of control. But the underlying fundamentals didn't change. The debt is still growing. The money supply is still expanding. The supply deficit in physical silver is still real. And the world is still methodically, deliberately moving away from dollar dependence. What happened this morning is just the next chapter in that story. Let me be clear about what I am and am not saying. I'm not telling you to buy silver. I'm not telling you to sell silver. I'm OG Jhone AG, not your financial advisor. And this is not financial advice. What I am saying is this. If you hold physical silver, do nothing. The volatility you're seeing is in the futures market and paper contracts. Physical silver is not going to zero. The industrial demand is real. The supply deficit is real. Ride out the noise. If you trade futures or options, understand the risk clearly. This is not an environment for leverage. Thin liquidity, China offline, March delivery approaching. Overnight gaps can liquidate positions before you even wake up. Size accordingly. And if you're considering getting into silver for the first time, understand what you're actually buying. Physical premiums over spot are running 8 to 12% right now, meaning dealers are charging $85 to $87 for metal that paper markets price at $77. That spread exists because physical is tight. Don't overpay, but also don't wait for paper price to drop to $60, expecting to buy physical at that price. It may simply not be available. Something shifted in the silver market this morning. Whether it was the final capitulation before a bottom, the setup for the next leg down, or the springboard for a March delivery squeeze that nobody in mainstream media is covering yet, we'll know soon. The next 72 hours, the next 11 days, February 27th, those dates are going to tell us a great deal. What I know for certain is this. The people paying attention right now, understanding the inventory math, watching the Shanghai premium, tracking the February 27th delivery clock, those people are positioned to make sense of whatever comes next. The people dismissing this, trusting that paper prices reflect physical reality, waiting for mainstream media to tell them something's wrong, by the time that happens, the move is already finished. You're hearing this now, that's worth something. Subscribe right now if you want real-time updates as March delivery approaches. I will be here every step of the way. Drop Silverwatch in the comments if you're tracking this with me. I read every single one. And if you know someone who holds silver, trades commodities, or has been watching what's happening to the dollar, share this with them. Not because I need the views, because they need to know. This is OG Jhone AG. I'll see you in the next update. This is not financial advice. Do your own research. Understand the risks. Sonnet 4.6. Extended